IVM.
Can you help our listeners understand debt products, from safest or rather low risk all the way up to high risk? What are the levels and what are the products?
Sure. So safest are bank FDs, right? Up to so I would say safe. They're almost 10 and 10 government backed, right? Then there are corporate FDs, AAA rated. Then there are debt mutual funds. Then there are individual bonds, high yielding bonds that you can find on Wint Wealth. These are secured bonds. Then there are unsecured bond, and then there are AT1 bonds, and then there are on the higher risk. There are a bunch of unregulated products like invoice bill discounting, leasing, etc. Right? So that's the risk spectrum I'll see.
And can you lose your shirt and pant in debt like you can in equities?
In FDs, no. In debt mutual fund, no. You will always have principal back. In bonds, probably yes. So if you don't diversify, you can lose shirt and pant. In unregulated product, eventually you will.
I want you to just talk to our listeners about the difference between listed and unlisted, regulated and unregulated, so that they know exactly what they're getting into. Well, it's a very important distinction that SEBI has made. Just help us in understanding that better.
Yeah, sure. So unlisted bonds do not get listed on exchanges, right? And they are out of purview of SEBI. So if anything happens, you invest in them, you can't go back to SEBI. So for any complaint or anything with your complaint, right? Right. Once the bond is listed, there are going to be far more disclosures, so you'll have more data to make that decision. Second, the platforms who are selling that are also regulated, right? So they have to abide by certain guidelines of SEBI. That broker license will make sure they follow all the guidelines, KYC norms, data security, etc. I think the core challenge today remains that earlier, like the practically ticket size was 10,000. Now it is 1 lakh, right? And for investing 1 lakh at the first go is very hard for a retail investor, right? So we see many investors now on our platform investing in 1 lakh ticket size plus bonds, who had earlier invested 10,000 in earlier bonds and had built confidence, had built knowledge, had built kind of a framework to evaluate a bond, and then eventually they first invested 10,000, then 20,000, and eventually 1 lakh, right? If I ask someone to invest 1 lakh today at the first go, it's a very steep task, right? So there is a high drop of that is happening.
Ajinkya, welcome to Paisa Vaisa. Thank you so much for doing this again for our listeners.
Yeah, thank you. It's pleasure being here, and thanks for having me again.
Yeah, I would have loved to have you in the studio, Ajinkya. Maybe we will be doing this online for reasons beyond my control. But let's just do a quick intro to what Wint does and your regulatory status. Let's start from there.
Sure. So Wint Wealth is a basically fixed income destination for retail investor. That means we will build everything out that is there in the fixed income phase. We have started bonds. We do SGBs also now. We'll do FDs. We'll do REITs. We'll do debt mutual funds. So bunch of stuff which is non-equity basically, right? So if you're doing anything in fixed income, Wint would be a platform through which you can invest, right? And when we say retail investor, we are targeting like retail investors who basically fall in bracket of about 5 lakhs to about 50, 60, 70 lakh. DIY investors, not somebody who is aided by financial advisors, right? So that's our target. So when we say retail, it's not someone who has 100 rupees or 500 rupees of SIP. It's generally somebody who is saving and investing 10,000 plus a month, right? So that's the TG we are working.
Yeah, we'll get into the target investor base
Yeah.
also in detail in this episode. Ajinkya, what is your regulatory status, right? Because that's a question that I ask all my guests just to be clear, that platform, NBFC, etc., etc. And I know that a lot has happened at SEBI. We'll get into that also. But what is
Yes.
your regulatory status?
I think we haven't got a broker license. The online bond platforms are dead brokers, are going to be dead brokers. We applied, we should get it anytime soon. But as a online bond platform, the space has got regulated, and we'll speak about it. But that's the major change that happened in last 2 years, right? But we should get NBFC. We have got NBFC license. We would get broker license soon, and we have also applied for a AIF license.
Fantastic. So we've done with the basics, folks. Like you said, I'll just recap for you. Wint Wealth does pretty much everything across the board in fixed income. Its typical investor profile is, someone who's at a certain income level, which we'll get into, who's looking for diversification and much more. And of course, in terms of regulatory status, they have applied for and should be hopefully getting an NBFC license, a debt broker license, and all of that. Okay, Ajinkya, I hope that I've summarized that correctly.
Yes, yes, yes.
Fantastic. So June 2021 and July 2023, 2 years. What's been happening? Let's get into that.
Sure. So regulation is one major change. Second, at that time we were pretty small. We had about 2-3 thousand investors. We had raised 50 crores. Now we have about 50,000 investors, little less than that, and we have raised 1,000 crores, right? And we have repaid
Wow.
about 400 crore. So there is good track record, and the scale has grown, obviously, right? We also now do HEBs. We are also fortunate that we raised money in between that, right? And things look much more stable, right? And we should be profit, like another 12 months we should be profitable. So we've come a long way, but we have to go a long way too.
Now let's get into the SEBI guidelines, right? Because when we spoke in June 2021, you were pretty much a platform and offering certain debt products to investors who wanted to, probably take a risk on fixed income, offering certain coupons. Let's get into what has changed, because in those 2 years, SEBI has also caught on to the fact that online bond platforms have emerged and they're offering pretty good options that were probably once open only for, say, HNIs and stuff like that. So, A, what were the guidelines? And B, what has changed?
Yeah. So the thing is, I mean, we were happy that there were guidelines. So unfortunately, we were seeing some players doing a lot of mis-selling, right? And when we saw that, we kind of got a hang why regulators act the way they do, right? So fundamentally, they said, "Hey, look, this is a growing space. We want to regulate. We want to protect retail investor. So you have to become a broker, so a debt broker, right? And there will be some special things that we'll do. So we're creating this subsection called OBPPs, online bond platforms, right? And that once you become broker, you can only do regulated products. You can't do any unregulated product. And there are certain disclosures, etc. Right, that you have to show to consumers so they can make a they can make an informed choice, right? I think that's the core change. Secondly, in listed bonds, ticket size, the minimum investment was 10 lakh for most of the issues, for 98% of the issues. So they've reduced it to 1 lakh, right? And for two, like remaining for other issues, it used to be 1,000. That's still 1,000, and it's mainly because of the compliance, right? Uh, but what had happened is most of the platforms were doing unlisted bonds because the ticket size in unlisted bond, there was no ticket size restriction. So at 10,000, 1,000. So SEBI said, we don't want you to do unlisted bonds. So any unregulated product. So effectively for retail investor, ticket size has increased from 10,000 to 1 lakh, right? Uh, while they came with this regulation, the SEBI chairperson mentioned that they will reduce the ticket size further once they're only serious players. So we are hopeful it is reduced further. But all in all, a great regulation, right? Uh, uh, and will have tremendous impact to make sure the serious players are there and investors are also protected. And when investors are protected, the markets grow, right? If there is demand.
Yeah, I
So
mean,
yeah, great regulation. Yeah.
I had Nikhil from Grip in the studio a couple of months ago, and I know that there is some similarity between what he's offering with and what you're offering. I want you to just talk to our listeners about the difference between listed and unlisted, regulated and unregulated, so that they know exactly what they're getting into. Well, it's a very important distinction that SEBI has made. Just help us in understanding that better.
Yeah, sure. So unlisted bonds do not get listed on exchanges, right? And they are out of purview of SEBI. So if anything happens, you invest in them, you can't go back to SEBI. So for any complaint or anything with your complaint, right? Uh, since the platforms that will be selling unlisted bonds will be also unregulated, so you don't know how they operate, how they maintain your data, whether there is counterparty risk, and you really don't have anyone to go like if they don't do the right thing with you, You don't really have any regulator to go to, right? And that's the main difference. And second, once so that's the difference, unlisted and unregulated, right? Once the bond is listed, there are going to be far more disclosures, so you'll have more data to make that decision. Second, the platforms who are selling that are also regulated, right? So they have to abide by certain guidelines of SEBI. They will That broker license will make sure they follow all the guidelines, KYC norms, data security, etc, fair marketing techniques, etc, right? So although the fundamental risk in the product doesn't change, but you get much more data in a listed product, and as an investor you are protected from fraud a lot in a regulated product, right? So that's the fundamental difference, right?
Very interesting when you say that although the risk hasn't changed. Okay. Rating. What about that? Does listing also include a rating out there, or that depends on instrument to instrument?
Yeah, no. So if the instrument has to be listed, it has to be rated, right? Yeah, but I mean, even in unlisted, people, like some of the bonds were rated, right? In fact, all the bonds we had on the platform were investment grade only, right? No, not just any rating, investment grade rating, uh, right? But the disclosure and listed are far higher. So if you are
Yeah.
taking up that risk as an investor, you can make much more informed decision whether that risk is worth taking or not.
Okay. Now, I want to just take a step back and get to the concept, right? Because when you started Wint, if I remember correctly, when we were talking about this as a concept, was that you wanted to democratize access towards products that were, probably accessible only to HNIs and offer the same to individuals who, should have an opportunity to look at high yielding instruments, probably have some risk also. How is that concept today in this day and age? Has that changed? Because SEBI has recognized online bond platforms. Do you think there are still some challenges in getting retail investors to access the products that you offer?
Uh, I think the core challenge today remains that earlier, like the practically ticket size was 10,000. Now it is 1 lakh, right? And one for investing 1 lakh at the first go is very hard for a retail investor, right? Uh, so we see many investors now on our platform investing in 1 lakh ticket size plus bonds, who had earlier invested 10,000 in earlier bonds and had built confidence, had built knowledge, had built kind of a framework to evaluate a bond, and then eventually they first invested 10,000, then 20,000, and eventually 1 lakh, right? If I ask someone to invest 1 lakh today at the first go, it's a very steep task, right? So there is a high drop of that is happening, and that is natural to happen. It's not very surprising, right? So I think that's the key challenge. That's number one. Second, I mean, if you are investing in bond, you should not be investing in one bond. You should be diversifying at least 10 bonds, right? Now, thing is, if the ticket size was 10,000, you could diversify with 1 lakh rupees. Also, you could diversify in 10 bonds, right? And like like very notional number, like somebody one has a 10% in bond portfolio. That means to invest in, if they want to invest 1 lakh in bonds, they should have a 10 lakh portfolio. And there are large number of retail investors who have that kind of portfolio, right? But now if the ticket size is 1 lakh, you invest in 10 bonds, that means you have 10 lakh of portfolio. And that, if that is 10% of your portfolio, that means your portfolio size is 1 crore plus.
1 crore.
And there are far few investors, right? So the TAM itself is low, right? And although we are figuring out a way where we offer, let's say, a bouquet of 20 bonds at 1 lakh ticket size, right? So that will make sure that portfolio, like even somebody with 10 lakh portfolio can potentially invest. But for them also to make the first investment of making that first investment of 1 lakh rupee is going to be hard, right? So we are bringing bunch of bonds where the ticket size is lower. So we are solving challenges, but the core challenge is of that higher ticket size at the entry, right? And I also understand the regulators point of view. I mean, what they are saying is, if we want more retail investor into it, there should be far more disclosures. So if you want the ticket size to bring, like if you want to bring bonds in ticket size of 1,000, 10,000, there is a way. It's not that there is not a way. There is far higher compliance for that, far higher disclosures, right? So only entities who are ready to do that should do that. And obviously costs are also prohibitive, but I think cost will be also solved, I think. So overall the industry is moving in right direction, and obviously as a platform I would want everything solved in one day, right? But that's not how things work. But overall, like, pretty happy with the way things are moving.
Yeah, I mean, you said you're at almost 50,000 investors, 1,000 crores, and I'm assuming that when the SEBI rule came out, there's probably some bit of a bump, or has that been taken care of? And now you're seeing a better run rate or better quality of investors coming in, given the SEBI's guidelines.
Yeah, uh, in our case, I mean, we are kind of, because when the regulation came, with that came a lot of compliance and all, and we are setting into that compliance. And we can talk about it. The underlying product, the tech flow, is also new, right? Where essentially the money will not flow to us as a broker; it will directly flow to the exchanges, right? And that all take, we had to build that compliance and system. So our volumes kind of are where they are, but the number of investors have dropped because the ticket size has increased suddenly from
Obviously.
10,000 to 1 lakh,
Yeah.
right? So that's where we are.
Ajinkya, let's go back to the investor profile, okay, and then we'll get into the product. Okay, so who are the investors do you think that are ideal for men? You mentioned about it in passing in the first half of this episode. Let's just go a little bit more into detail out here. Probably in terms of familiarity in financial products, diversification, not just ticket size of the investment.
Uh, Got it. So first is, what is this instrument? Basically, these are bonds, right? And why should you invest in them? Is if you have a short-term goal, right? And if you don't want to invest in equity, then you can invest. Because this is an asset market, parking emergency fund here is probably not a good idea. Not probably, it's not a good idea, right? So something that is not your emergency fund, but something that is less than 5 years, so you don't want to, like, your investment horizon is less than 5 years, so you don't want to invest in equity. That's where you want to invest in bonds, right? And like, because, like, this, they will have risk, and these risk can be managed well, but the key factor to mitigate or manage that risk is diversify. So you should invest in 10 bonds, right? Now, depending on your portfolio, you might allocate 5% or 50% of to the bonds, right? Or could be 100% for someone. We don't know, right? So ticket size into 10 is your investment, minimum investment, right? And if you are at 10%, then 10x. If you are at 20%, then 5x should be your portfolio, right? And so that is one way of looking at it from a portfolio approach. That essentially translates into how much income you have, right? And that baseline comes to be about 5 lakh to someone about 50, 60, 70 lakh, above which people have access to personal finance advisors, either distributors or RI or someone. At that juncture, things move very differently. They have access to offline channels, etc. So we don't really cater to them much, right? So that's our TG, right? Somebody who earns, let's say, 5 lakh to about 50, 60 lakh, who want to invest in bonds, and so they have a short-term goals. They want to invest in something that beats inflation, and they are okay with reasonable risk, not very high risk, but they should definitely understand that this comes with higher risk than FD. FD is low risk. This is high risk product, right, compared to FD. And that, yeah, that's the TG and that's the use case.
Okay. And how do the bonds work? In the sense that they come across tenure. So it could be 1 year,
Yeah,
5 years, 3 years, and just some indicative yields out there. And how regular is the payout? Like, could this be targeted at someone who wants to take a reasonable risk, but also wants, say, a regular payment of interest? Could be monthly, quarterly. I don't know. So how
yeah.
does the profile of that work? The product.
Sure. Yeah. Now, again, the kind of bonds we bring on the Wintwell platform are very peculiar, that give you about 10, 11% yield. And why we, sorry, why we do so is we are targeting to retail investor, right? Uh, and for them, if the bond yield is less than 9%, then FDs are much more attractive product, right? Because you are investing less than 5 lakh. Probably if you want to invest to 10 lakh, then you can open bank account in two banks, etc, right? And especially small finance bank, because up to 5 lakh it is guaranteed by the government. And now there is a law that if the bank goes down, goes under, you will be paid in 90 days, right? So if it is below 9%, I don't think that risk is justified, right? So 9 to 11% are the kind of bonds that we bring to the bring on the platform, right? Now, these are issued by NBFCs and they come with different tenure, right? And obviously, uh, as a platform, we don't think, if especially in this segment, right? If you're taking a GSEC government bond, you can probably take a 30-year risk. That's fine. But especially if you're looking for a high yield bond, we don't think the risk premium is good for beyond 3 years. So we generally keep the bonds tenure less than 3 years, right? And then there are a variety of bonds. Most of the bonds today, we make sure that the principal is most of the bonds on our platform. The principal is repaid regularly, so the risk comes down, right? Today, when you uh, buy a bond, you have a lot of data on the entity, right? Now 1 year down the line, you're going to have less data, so you want less exposure. If you have more confidence, you can again reinvest that money, right? So if make sure we like so we make sure as a platform we bring 3 to 4 bonds every month at least, so people get avenues to invest, but they also get regular, not just interest but principal payouts also, so the risk is reduced, right? So overall tenure less than 3 years, so 18 to 24 month is a sweet spot. Quarterly regular principal payments, interest payment can be quarterly or monthly. Those are the kind of bonds you'll majorly see on Wintwealth platform.
Very nice. I want to understand the product from an angle of when you said it's listed and regulated now. So, what do I need to start up? Do I need to have a, for example, demat account? So that's where the bonds will actually sit, and you effectively act as a broker. So you will charge me commission and the service tax on commission, etc. Can we just get into the nitty gritty of how an actual transaction works?
Yeah. So once like we are about to get a broker license, once we'll get a broker license, we'll become a like how the transaction works on Zerodha, Agro, or any broker for that matter. We'll also become we'll also have a demat account, so we'll also have a DPA. So you'll have to open account with us, and you can transact how you transact on Zerodha or Grow or Upstocks or Dhan or any for that matter any online broker platform, right? So
Oh,
the inner working are not that different actually.
okay. So I want to understand. So you also mentioned technology. Can we get into that? Because that's one thing that's refined a lot in your product. Like when I download the app, what I see, how I transact, and we just go under what's under the hood out there. Because a lot of these products are also, they also have great UX and UI for the investor to have a transaction done. Let's talk about the technology for a bit.
Sure. So the technology I was speaking to that was under this. So under once we get a broker license, there is new flow called RFQ. So earlier it was the original name was request for quotation, which was kind of a debt platform for institutional players, right? Now it has been modified to accommodate retail also, right? The fundamental difference is, let's say today in any broker, you basically load money into that broker's account or wallet or whatever you call it, right? And then you buy and sell whatever securities that you want, right? In RFQ, that money will not go to broker. So you'll punch in the order, I want to buy this, and then on payment gateway, you'll directly make payment to the gateway, to the exchanges, right? So there is far lesser risk on broker and money doesn't flow. That makes our job easier also as a broker, and that it is much more in favor of retail investor. And I believe that because we are new platforms and we are not scaled yet, these are SEBI is trying to implement this across OBPPs, and once this platform is stable, I believe or I guess this will be this will be adopted on a large scale for mainstream equities also. Obviously there are some challenges to that, but I think the key difference is money will directly flow to exchanges.
Okay. I want to understand that from the diversification perspective, right? Because this is also a very good diversification tool for someone who's looking at equity or debt, or even within debt, building a portfolio of bonds. How should I compare this versus a debt mutual fund? Or are you saying that someone who wants a debt mutual fund should go to a debt mutual fund and Wint is for something else?
Yeah, no. So the fundamental difference is debt mutual fund. You are basically saying I trust the fund manager or the fund to make right choices, right? And you give up that autonomy. You and in effect you also get liquidity, so which is higher in debt mutual fund. Second, you get even if you invest 100 rupees, you get much more diversified portfolio, which is very crucial in debt investment. Uh, so these are some of pros and cons, right? The problem in mutual fund is earlier they were much more attractive because there was this taxation arbitrage, right? Indexation benefit. After that, today mutual funds, the problem is they have sectorial caps, right? So they can, like I guess in NBFC sector they can invest only 25%, right? So that is one reason where their yield is dampened, right? Second is they have to keep some, I guess, 10% assets in liquid, right? And that also decreases the yield, right? So for retail investors, they are not at all attractive then, right? You better go and book a FD with a small finance bank. Why bother with this YTM and credit risk and fund manager and doing all this, right? Just open an account in FD, and then there is, if the interest rate increases, there is MTM loss, and it's so much complex, right? Yeah, FD is just clean way of doing it, as long as you do below 5 lakh. And I'm very focused on retail investors, because that's the persona we cater to. Obviously for HNI, he cannot go and park 1 crore in a small finance bank without actually understanding the bank, understanding risk, right? For a normal retail investor, I think small finance bank FD would be a great alternative to a debt mutual fund. I don't think, like, I would personally invest in debt mutual fund in any way. There is small benefit that in FD the interest is tax per year. In debt mutual fund it is at the exit, but it is far too complex actually.
Yeah, yeah.
And people don't think that rationally, and not nor they should be expected to so much rational, right?
Ajinkya, can you help our listeners understand debt products, from safest or other low risk all the way up to high risk? What are the levels and what are the products?
Sure. So safest are bank FDs, right? Up to so I would say safe, they're almost 10 and 10 government backed, right? Then there are corporate FDs, AAA rated. Then there are debt mutual funds. Then there are individual bonds, high yielding bonds that you can find on Wintwealth. These are secured bonds. Then there are unsecured bond, and then there are AT1 bonds, and then there are on the higher risk there are a bunch of unregulated products like invoice bill discounting, leasing, etc. Right. So that's the risk spectrum I'll see.
And can you lose your shirt and pant in debt like you can in equities?
In FDs, no. In debt mutual fund, no. You will always have principal back. In bonds, probably yes. So if you don't diversify, you can lose shirt and pant. In unregulated product, eventually you will.
Okay, so folks, if you want to keep your shirt and pant on, listen to what Ajinkya just said right now.
Yeah.
Okay, Ajinkya, it's 2023 now, and as you know, in the last 2 years, the landscape has changed a lot. So a lot of other bond platforms have also come up. Grip was there, then you were there, then, and you guys are still there now, thankfully growing bigger. But if there's someone who's listening to this episode who's not checked out a bond platform, could you give us a checklist to our listeners of choosing a good platform to buy or sell, to transact in the bonds that we've been talking about in this episode?
Yeah, I think since everybody's new and everybody's evolving, I mean, first, and bond has not become a commodity yet, right? Let's say if you are buying any equity stock, right? Then apart from transaction value, you wouldn't look at many other things. You'll just look at cost, right, across brokers and which are cheapest. In case of bond, it is not commoditized yet, right? So you should look at the team, whether they have experience. Second, what is their philosophy of bringing bonds, right? Are they like uh, how we are fundamentally different across all bond is we are bringing curated bonds. So we do due diligence on bonds, and whenever we bring a bond on any bond on Wintwealth platform, we actually co-invest as a company, and we invest 2% of the issue size and hold till maturity. That makes sure we have skin in the game, right? So we have done our due diligence. We have checked the entity, promoter, processes, bunch of parameters, on ground due diligence, and then we have brought that bond, right? And that is the fundamental difference, right? So are you if you are a bond expert, then you don't need curation, right? Then you can buy any bond, right? Then but so I'm just saying bond experts already know what needs to be done. I'm saying somebody who's looking to invest in bond for the first time, curated platform would be better, is our opinion, right? So that's what we do. Rating, we don't think it's a great indicator, so we kind of don't look at rating as the only criteria, right? Because the ratings are flawed fundamentally, and we can talk about it. uh, but second is, what is the collateral, right? uh, what is the uh, is it a secured bond or unsecured bond? That becomes very important. And what is the kind of collateral that is offered, right? And second, unfortunately, I mean, people, even listed companies, do a lot of creative accounting, right? So it's tough to like, if you do like, so the numbers can sometimes be misleading, right? So therefore, be very very careful if you are just choosing by yourself, right? uh, So I think, yeah, I think go read the balance sheets, the bond terminologies, like the IM, the investor memorandum, etc. Very, very, very carefully.
You just gave me one more question. I just heard you saying ratings aren't the best indicator. Can you? I wanted to go into that. Of course, I. You said we can go into that, so please go into that.
Yeah. So look, I mean, how ratings basically rating indicate probability of default and not probability of loss. Now let's understand this. Let's say if there is any entity and you give them money and they're supposed to pay you after 2 years, right? So rating will tell you on that given day whether the entity will pay you or not. So it's kind of is a indicator of liquidity also, right? And majorly liquidity, right? What as an investor, as a retail investor, I'm more interested in if they get delayed, will I be paid back or not, right? And let me show you, like tell you an example. So if it is a triple A rated entity, right, and they issue unsecured bond, it's still rated triple A. And if there is a, let's say, A rated entity or even triple B rated entity which issues a secured bond, it is going to be rated triple B or A, right? And the security is really good, let's say 2x, right? Now, and this bond has maturity of 2 years. After 2 years, the chance of this entity paying on that day is obviously higher, triple A rated entity. But if they default, right, it's an unsecured bond, you will hardly get anything. I mean, you are more likely to not get anything, right? But in a triple A rated entity, even if they default, if there is a collateral and that gets recovered in the process, you will most like you're more likely to get money, right? So you should not. Rating is a good indicator of liquidity risk, but not credit loss, right? And I think when people think of rating, they think it is a kind of a credit indicator, but
Exactly.
it's not. And that is defined by what is the bond, what is the like what are the terms, conditions, right? And that also varies bond to bond. I mean, in secured bond, right? And so therefore, rating is not a good indicator. Rating definitely indicates liquidity risk, but rating generally is not a good indicator of credit risk.
Oh, very interesting. And you also gave me the lead into the next question, right? Because what's my worst case scenario out here? If and in your experience, given that you've now been here for whatever more than 2 or 4 years, what's been your track record so far in terms of NPAs at a corporate level, if you can tell us, and all I mean at your company level, if you can tell us, and also at a consumer level, investor level, what's the worst case scenario that I'm looking at, and how do you help me navigate that?
Yeah, worst case scenario is you'll lose the money when it's secured bond, so there is some fraud happening, etc. I mean, we obviously keeping track. Fortunately, till now we haven't seen any default, not even any delay, not even any stress in any entity that whose bond we are bring on the platform. Many of these entities have been upgraded. Many of these have received further rounds of equity, and like we had an entity whose rating got upgraded 4 notches overnight, which is crazy. But then generally it doesn't happen. Uh, but it's not like it cannot happen. It's not guaranteed, right? It's not
Obviously.
government guaranteed, right? There is risk, so you have to mitigate risk by diversifying well, right? If you diversify, let's say, uh, like very broadly, right? If you let's say invest in 10 entities, 10 bonds, and average yield is 10%, even if one entity defaults, right, you will still get the principal back. And obviously that some of that money will come back, right? So I think then that risk could be worth taking, right? But if you're just investing in one bond, if that default, you're gone, right? So not worth taking that risk, in my opinion.
And at least touchwood so far has not happened at Wint as yet.
Yeah. We are very, and I think that 2% skin in the game, make sure that everyone is aligned, right? Because it's not just that we are making money by selling bonds. Then, like, if we keep doing that, at some point of time, incentives, you know, will diverge, right? If we have skin in the game, it makes sure our incentives are aligned within. And there is this famous saying by Charlie Munger, right? Show me the incentives, and I'll show you the outcome. So we have made sure that incentives are aligned.
Yeah, that's good. What lies ahead? Where you said 50,000, almost 50,000 investors, about 1,000 crores of transactions or transaction value. What are your plans going forward?
Yeah. So two, three key problems that we need to solve. One is, how can we solve for this at 1 lakh ticket size? How can we solve for diversification? Right. We cannot solve for lower ticket size unless SEBI decides so, but we can definitely solve diversification with 1 lakh ticket size, right? So how can I offer a bouquet of bond at 1 lakh, which is diversified across 10, 20 bonds? That's number one priority. Second, how can I increase the liquidity in the system, right? So what we have found out is people want more and more liquidity, just to take a plunge, and they want that liquidity as an option in case they require, right? And even if not a guaranteed liquidity, there should be some mechanism that liquidity is generally available, right? So that these are the two things that we are working on, right? Now that's on the bond platform. We are also launching FD platform, right, where you will be able to book FD of the top NBFCs, and also SAB, bunch of SAB, small finance bank, completely online, and you can withdraw online, right? So that's in pipeline.
Okay, I just wanted to do a recap on the tax implications. I kind of just thought of that also for our listeners, that how does tax work out here? I think there'll probably be tax on the interest that I earn, and anything else. And how does that, what slab does it attract, or what tax does it attract?
Yeah, it's taxed at like FDs only at your marginal tax rate. So if you are in 0% tax bracket, it will be charged zero. If you are in 10, then 10%. Uh, you get the 10% TDS is cut on the interest, but if you fall in 0% tax bracket, you can actually claim it back by filing tax.
Okay, great. And I just noticed that on your website, you go with 9 to 11% fixed returns. So I think Nikhil uses probably an IRR at Grip. So just a small recap for our listeners: why are these terms important, and what do they mean? I mean, is fixed returns the same as a rate of interest, or am I to assume something else from that?
No, I think what we fixed return is something that people understand. That's why we've written there. But generally, if you are investing in any fixed income product, you should look at XRR. I think XR is the best metric to judge the return, right? Not like, because the principal get paid in between in many good products, right? So XRR is the good indicator in my opinion. And what we meant there is XRR only. I mean, it's obviously written on the asset pages, but XRR is a very technical term. If you throw that, people just get confused, right?
Yeah. So, folks, we've completed the main part of the episode, and if there's anything else, you have any follow-up questions out there, I encourage you to reach across to Ajinkya on LinkedIn, and even Wint Wealth has a pretty comprehensive website, and they are very proactive in answering investor questions that you have. So reach out to them if you have any specific questions on that. Okay, folks, so that completes the product, technology, investment, bond, the basic core content of this episode. If you want to know more, please do reach out to Ajinkya. Ajinkya, you're very proactive on LinkedIn, active on LinkedIn, and Wint itself is also quite proactive, right? So if anybody who's listening into this wants to reach out to you, they're open to do
Yes.
that, right?
Yes. We are generally very happy. You can reach out to us on WhatsApp. We can solve queries. In fact, we have an education team which gets on Zoom calls with investors one on one to answer their questions, educate them about risk, etc.
Excellent. So, folks, if there's something that I didn't cover, and I know that you've got more questions than me, so please reach out to Win directly. Okay, now that we're done with that, I think let's get into one last thing before we go, which is that this entire you call it influencer, finfluencer, content, regulation. So much has been happening in the last few months that wasn't the case back in June 2021 when we spoke. Wint is very popular. When I go to your YouTube channel, there are all sorts of very interesting videos out there that I'm pretty sure that that they've got a lot of traction. You yourself are quite popular on LinkedIn. I see that the conversations that you have out there, they generate a lot of traction. What are your views here, on this entire discussion that's been happening on incentives, finfluencers, ecosystem, creator, content, and everything? I want you to sit on both sides of the table now, okay? Talk to me as a creator of content, and talk to me as a consumer of content. What do you think, of whatever's been going on so far?
Yeah, I mean, look, we are a creator, but we have a more like creation. That creation is not a end to us; it's a means to something bigger, which is Wintwealth, right? So our creation incentives are very different from a normal creator, right? But I can understand. I think as a creator also, like, people would want to be regulated. What they fear really bad is over regulation, right? And on RIA side, we kind of see that, and obviously, uh, we have all opinions, but regulator has a different view because they see a market more transparently, more deeply, right? But overall, I am of the opinion that influencers should get regulated, right? And I know a bunch of them, and most of them are very pro, like they would want to get regulated. It's just that what kind of regulation, right? If it's get over regulated, then that creates business problem and sometimes survival problem also. But I think generally a serious creator would want to be regulated in some way, right? That also provides business stability. So that is the view from creator side, I think. Right. I think from a consumer side, or like, it makes ton of sense to regulate, right? I mean, because like the country, how it is, like we are moving so fast because of this digital transformation, right? And if we don't make this sector completely unregulated and let it burst out on its own, the perverse incentive will create ruckus, right? And that we are. But if you over-regulate, I mean, what these, like, you have to also give credit to these influencers, is they have created massive interest in investments, right? uh, Obviously they have done some wrong advertisements, some stupid calls, right? Right. So, and I mean, whoever I know, I think majority of them are well intentioned people. It's just that they made mistakes, right? And that's okay. So it makes sense to regulate. You have to give them credit that they bring the larger audience to investment, and they made sure that they think about money very seriously at their young age. Obviously they've done a bunch of wrong things, and regulation should solve for that, right? Without without killing that business. Otherwise you have a large set of population who needs financial education, and these people are doing it, right? And I think SEBI has taken already initiatives in that direction, and it makes sense, I think. I don't think anybody has a stance it should be unregulated. You are obviously talking about money,
Hmm.
and it should be regulated, right? To what kind of regulation, what should be allowed, and there will be, I think, as we go, I mean, as we progress, that will keep evolving, but there should be some regulation as soon as possible.
Sure. Let's see what happens on that. Okay. And our last and final last standard question, Ajinkya, what book are you reading right now, or content you're watching or anything? And do you have any recommendations for our listeners out there?
So I'm not reading any book as of now. So I stopped reading some time back. I said, "Ki, I've read too much. I need to build a
Hmm.
good business right now."
Sure.
Interestingly, I'm thinking of writing a book.
Oh my, please
I'm
do.
just
Please
thinking.
do. Yeah, yeah, no, please do. Yeah.
Yes, yeah,
And
and maybe
other than that,
like I'll have interesting things to share in 3 to 6 months if that goes as per plan.
fantastic. So, folks, we will look forward to that book that Ajinkya is writing. But that is a wrap on this episode of Paisa Vaisa. My guest, Ajinkya Kulkarni, co founder and CEO of Wint Wealth. Ajinkya, thank you so much for doing this for our listeners.
IVM.